no jargon and no scare tactics. Here is the fast answer right away, because I know you did not come here for a long-winded story before getting to the point. As of the 1st of July 2026, a single person who owns their own home can have assessable assets of up to $733,500 and still receive some part pension. $500,000 is well under that number. So yes, in most cases, a single homeowner with $500,000 in the bank can still receive a part-age pension. Now, before you get too comfortable with that answer, I want you to stay with me, because there is a second test running quietly in the background that trips up more retirees than the assets test ever does. I will walk you through exactly what that is in a few minutes, and it might change the number I just gave you. Let's start with what actually counts as an asset, because this confuses almost everyone I talk to. Centrelink does not care what is in your wallet. They care about the total value of what you own minus your home. Your house, the one you actually live in, is not counted at all. That surprises a lot of people, and it is worth repeating. Your family home, no matter how much it is worth, sits completely outside the assets test, as long as it is your main residence. But everything else gets added up. Bank accounts, term deposits, shares, managed funds, superannuation, once you are over age pension age, investment properties, caravans, boats, even the market value of jewelry and collectibles if it is significant. All of it goes into one running total. So if your $500,000 is sitting in a savings account and you own your home and you have no other significant assets, Centrelink adds that $500,000 to your assessable assets and compares it against the limits I mentioned earlier. Here is where it gets interesting, and here is something almost nobody explains properly. There are actually two separate thresholds for every situation, not just one. The first threshold is the point where your pension starts reducing. The second threshold is the point where it disappears completely. $500,000 for a single homeowner sits right between those two numbers, which means you are in what Centrelink calls the part pension zone. Let me give you the exact figures, because vague numbers do not help anyone plan their retirement. For a single person who owns their home, the full pension cuts off once assessable assets pass $333,000. Above that figure, your pension starts reducing gradually. It does not disappear overnight. For every $1,000 you hold above that lower figure, your fortnightly pension reduces by $3. That reduction continues until you reach the upper cut-off of $733,500, at which point the part pension stops altogether. For couples who own their home together, the combined lower threshold is $499,000, and the combined upper cutoff is $1,102,500. If you do not own your home, those numbers move up quite a bit, because Centrelink recognizes that renters need more of their savings just to keep a roof over their heads. A single non-homeowner can hold assets up to $600,000 before the pension starts reducing, and the part pension does not disappear until around $1 million. Now, quick pause here, because I promised you earlier that there was a second test, and this is the part that catches so many people off guard. I want you to really pay attention to this next section, because it comes right around the 2-minute mark of this video. And this is usually where the real story begins. Centrelink does not just look at your assets. They also run something called the income test. And here is the twist that surprises almost everyone. Centrelink does not look at what your $500,000 is actually earning you in real interest. Instead, they use something called deeming. Deeming means Centrelink assumes your money is earning a certain rate of return, whether it actually is or not. Even if your money is sitting in a low-interest account earning almost nothing, Centrelink still assumes it is earning the deemed rate. From the 20th of March, 2026, those deeming rates increase slightly by half a percentage point to keep pace with the interest rate environment. For a single person, there is a lower deeming rate that applies to the first portion of your financial assets and a higher deeming rate that applies to everything above that. For couples, the same idea applies, but the thresholds are combined. This deemed income is then added to any other income you receive, like part-time work or a small business, and compared against the income test limits. Why does this matter for someone with $500,000 in the bank? Because even if you pass the assets test comfortably, as we established you would, the income test might reduce your pension further, or in rare cases, more than the assets test would have. Centrelink always pays you based on whichever test gives you the lower amount. That is the part almost nobody explains clearly, and I promised earlier I would come back to it, so here it is now in plain language. 2 tests run side by side, and the stricter one wins. Let me bring this to life with a simple, relatable example, because numbers on their own can feel a bit dry. Picture a woman named Margaret. She is 69, she owns her home outright, and she has been a careful saver her whole working life. She has $480,000 in a term deposit and another $20,000 in a regular savings account, giving her exactly $500,000 in financial assets. She has no other significant assets besides her car and her furniture, which are worth very little in Centrelink's eyes. Under the assets test, Margaret's $500,000 sits comfortably above the full pension threshold of $333,000, but well below the cutoff of $733,500. That puts her in part pension territory under the assets test. Centrelink then also checks her income, using the deeming rules I just explained. Her actual bank interest does not matter here. What matters is the deemed amount. In Margaret's case, once that deemed income is calculated, her income test result and her assets test result are compared, and Centrelink pays her whichever result gives the lower pension. In most cases, like Margaret's, the assets test tends to be the binding one once savings pass the $400,000 to $500,000 range. But every situation is slightly different depending on other income sources. The end result in a typical case very close to Margaret's is a part pension payment that still puts real money in her account every fortnight, along with something just as valuable, a Pensioner Concession Card, which brings discounts on medicines, on energy bills, on council rates in many areas, and on public transport. That card alone is worth mentioning on its own, because I speak to so many retirees who assume that if their pension payment is small, it is not worth applying. That is one of the most costly misunderstandings I come across. Even a tiny part pension of a few dollars a fortnight can unlock that concession card, and the savings from that card alone can be worth thousands of dollars a year, especially on prescription medicines and utility bills. Let's shift gears for a moment, because I know some of you watching this are not in Margaret's exact position. Maybe you are a couple, maybe you do not own your home, maybe your $500,000 is spread across superannuation and a rental property rather than sitting in cash. Does the answer change? For a couple who own their home together, $500,000 combined sits just above the $499,000 full pension threshold, which means a couple in that exact position would likely see only a very small reduction to their pension, if any at all, since they are barely over that lower line. They would remain nowhere near the $1,102,500 cutoff. For a single non-homeowner, $500,000 sits below the $600,000 threshold for the full pension, meaning a single renter in that position might actually receive closer to the maximum pension rate, assuming their income test result does not pull that number down instead. This is exactly why I always encourage people to check their own specific numbers rather than relying on a friend's experience or a story they heard at the local bowls club. Every situation, homeowner or not, single or couple, cash or superannuation, shifts the outcome. Now, here is something coming up that I've been holding back, and it is one of the most overlooked strategies retirees ask me about. What happens if you are sitting just above one of these thresholds, close enough that a small change could shift you from no pension to a part pension, or from a small part pension to a bigger one? There are legitimate, well within the rules, ways some retirees structure their affairs to make the most of these thresholds. Some choose to spend on home renovations, since money spent improving your exempt family home effectively moves it out of the assets test entirely. Others look at funeral bonds up to a certain limit, which are also exempt from the assets test. Some retirees gift money to family, though I want to be very careful here because Centrelink has strict gifting rules, and any amount given away above certain limits within a 5-year period is still counted as if you still owned it for exactly 5 years. This rule catches people out constantly, and it is one of the most common reasons a pension application gets rejected or reduced unexpectedly. I want to pause on that gifting rule for a moment longer because it deserves real attention. If a retiree gives away, say, $50,000 to help a grandchild with a house deposit, thinking it will help them qualify for a bigger pension, Centrelink will still count a portion of that gift as a deprived asset for 5 full years from the date it was given. This is not a grey area. It is written clearly into the rules, and I have seen it surprise people who genuinely had good intentions and simply were not aware. So if you are thinking about restructuring your assets before applying for the pension, or before your assets creep closer to one of these thresholds, please speak with a financial counsellor or a Centrelink Financial Information Services officer before making any big decisions. That service, by the way, is completely free, and it exists specifically to help people in your position plan ahead properly. Let's bring this back to the core question one more time, because I want to leave you with total clarity rather than just a pile of numbers. Can you have $500,000 in the bank and still get the age pension in 2026? For the vast majority of single homeowners, the answer is a clear yes, and you would likely land somewhere in the part pension range. For couples who own their home, $500,000 combined puts you right at the edge of the full pension zone, often with only a small reduction. For non-homeowners, your thresholds are more generous again, which often means an even better outcome. The one thing that could genuinely change all of this is the income test working alongside the assets test, along with any other income you might have coming in from part-time work, rental income, or other investments. That is why I always suggest running the actual numbers through Centrelink's own calculator or speaking directly with Services Australia, rather than assuming your situation matches someone else's story exactly. If this video helped clear up some confusion for you, please give it a thumbs up. It genuinely helps this channel reach more people who are trying to make sense of these rules just like you are. If you have a moment, leave a comment below and tell me your own situation, whether you are a homeowner, a couple, or single, and I will do my best to point you in the right direction based on the current rules. And if you subscribe to Centrelink Pension Bulletin, you will not miss what is coming next, because in the very next video, I am going to break down exactly how gifting rules work, step by step, including the 5-year rule I touched on today, and I will show you the safe, allowed ways many retirees still manage to help their family financially without putting their own pension at risk. Thank you so much for watching all the way through, and I will see you in the next one.